Hey everybody, Travis Watkins here, coming to you on a good Friday afternoon, and I hope y'all are doing well. If you've been enjoying the content here about how to solve IRS problems, you might want to check out my book where we talk about these things. You can get a free download of that book at traviswatkinsbook.com, and you fill out a couple of things and we'll send you a download for that book, and you can have it for your very own self for free. So go check it out. I think you'll get something out of it, and you don't even have to pay a lawyer necessarily to get that information. So go check it out. Today we're going to be talking about IRS payroll matters. In other words, if you are a business owner and you have employees, then this could mean if you fail to pay any of your payroll taxes to the IRS, if you get behind there in any way, the IRS holds this type of tax and the non-payment of this type of tax in highest regard. It is the crown jewel, I always say, of IRS collections. And the IRS really has cracked down on payroll tax matters over the past few years. It focuses almost all of its energies and man and woman power inside the agency when it comes to collection. In other words, the IRS revenue officers that are out in the field, they're the bulldog tax collectors, in case you don't know. And they're nasty deals, these payroll tax matters, and they'll go after a business and business owners alike for getting behind, even like, say, a quarter nowadays. And they hold these in such high esteem and such a priority in collections because you are, as a business owner with employees, the involuntary trustee, I always say, of the employees, and therefore the government's tax money, because you are supposed to be withholding taxes from your employees, and when you fail to do so, then it becomes such a big matter that they can assess these against you, the business owner, personally. So let's talk a little bit about that here. This is, as I mentioned, where you get into revenue officers from the IRS, those collection personnel. And typically these folks like to jump out of the woodwork on payroll taxes for several different reasons. Forgot the mic up here. Hopefully you're hearing me okay. Let me get that going here. Sorry about that. They don't like to, call in advance. They don't like to set up appointments on these types of things. They like to use the element of surprise there, mainly because they really don't want you hiring a tax professional, someone like myself, out of the gates there, because they want to collect as much money and as much data on where the money is as possible without the pesky annoyance, I guess, of having a tax lawyer or CPA standing in between you as the business owner and them getting the main line to your money, finding out where stuff is located, what are the assets, and what are the bank accounts and things like that. Another reason for that element of surprise is really if you have employees, they really don't care if you're there on premises when they show up or not. Some of the best information comes from the folks, if you're an absentee owner, for instance, of a business, their best information may come from your employees who often mistakenly believe that these revenue officers have more power than they actually do. In other words, they may think that they're like showing up with a warrant. They got to answer all these questions and things like if the police showed up, for instance. But these folks are not attorneys. They're not, in most circumstances, they're not police officers. They don't carry a badge. They may carry a badge, but they don't carry a firearm or anything like that. They are merely there to collect money at that point. So since the element of surprise is such a big deal, I thought I would tell you who you might be looking out for if you're a little behind or you're a lot behind on your payroll taxes. These are the revenue officers in the state of Oklahoma, in our area. They vary from state to state, and they fluctuate from time to time because in the last few years, as budgets have diminished at the IRS, a lot of seasoned revenue officers have started to retire or have already retired. And what you're dealing with in many situations, since the more seasoned revenue officers have retired, is you're dealing with an employee at the IRS who may not have that much experience. So I'm not going to talk too much about that, but I'm going to tell you who these folks are so that you know. And when these people show up, it means you is in trouble. They are not your friends. Okay, if you owe money, you need to seek some type of representation if you are being visited or contacted by these people. And here they are in the Oklahoma City area: Onlia Cherry, Janetta Smith, Deanne Brackbill, Curtis Holtzel, Pam Vinzer, Vicki Woods, Patrick Oswald. If you are in the Tulsa area, you might be assigned to one of the following revenue officers: Ron Thomas, Dale Bostert, Christy Riley, Stephen Schrader, Stuart Anderson, Tanya Quisenberry, and Olusala Dada. These are the revenue officers that are in the Tulsa area. And I should say that they also, from time to time, switch territories, and the territories aren't necessarily set in stone, but basically anything north of I-40 and I guess east of probably east of I-35 is going to be those Tulsa folks. There is one revenue officer out in far western Oklahoma. Maureen Weathers is her name. So again, if you're getting contacted by these folks, you are in some trouble, and you need to seek some professional advice, would be my take on this, because these individuals, and really all collection employees at the IRS, are tasked with what I consider to be a pretty difficult and kind of a conflicting, really in many ways, task, and that is to, first of all, look out for the government's best interest, and to also take into consideration the interests and the rights of taxpayers. So a very difficult task, I would say, for a non-elected person to, with a whole lot of power, to juggle. And in many cases, it's my opinion that the government's best interest gets the absolute top priority there. Okay, so let's talk a little more in depth about what is the payroll tax and kind of how this all will shake out if you owe the IRS some payroll taxes. it comes as a surprise, I guess, to some business owners that when you have employees, you must withhold taxes for them. And as I mentioned, you become the involuntary trustee of those taxes for the United States government. So when you don't pay those over to the government, they see you as essentially someone who is taking money from the government. You are a common thief is really, I think, how they see things in many, many cases. The payroll tax itself, or I guess I should say, the payroll trust fund portion of the payroll tax is the IRS's top priority. And what I'm talking about here is this trust fund is made up of half the Medicare, one half the FICA, 100% of FUTA tax, which is federal unemployment tax, and then also 100% of the employee withholdings that you're supposed to be keeping, okay? This portion of the whole thing that they call payroll tax is the top priority with the IRS. It's never dischargeable in bankruptcy. If the business fails, if the business burns to the ground, they don't care so much. I wouldn't say they don't care. They care less about the other part of the payroll tax than they do this part of the payroll tax, the trust fund portion. Okay, so therefore they can really do a whole lot of things to a business and its owners in order to collect this part of the tax. And you know, even if the business burned to the ground, they can still collect it because they can assess the trust fund recovery penalty against what they call responsible persons, and that's a term of art at the IRS. Here's kind of the general list of people that they could come after personally for that portion of the payroll tax, the trust fund portion. And I don't know if I mentioned it, but I should. Trust fund portion is kind of a difficult thing to calculate. It's just know that it makes up anywhere from about 30 to 70% of that whole thing they call payroll tax. The other part of the tax is the non-trust fund portion of payroll, and they want to collect that part too, but they want to collect the trust fund portion the most. Okay, so here are the general list of people that could be assessed a personal liability from that business trust fund portion of the payroll tax. Officers and shareholders of the business can get it. Anyone on the bank signature cards for the company could potentially get the trust fund assessment. Anyone who actually signed checks for the company can get assessed with that. Anyone who has hiring and firing abilities at the business. Anyone who signed a 941 quarterly payroll tax report for the company could be assessed with that trust fund portion. And anyone who is active in the day-to-day management of the business. In other words, if you have the ability to choose, I guess you would say, the which creditors of the business get paid, or in this case don't get paid, then you probably have the amount of control of the business to become a responsible person. And the IRS likes to keep its options open. It's not just one person typically, unless it's just a very small company. They can do it against multiple people. They can assess against multiple people, and then they don't necessarily have to collect from these people in a pro rata type of format either. So it's really it's a deadly deal. It gives the IRS the ability to really leverage multiple people, multiple folks with power in a business to get that portion of things paid. And they will work folks against one another, officers, things like that. I've even seen nonprofits get in payroll tax trouble, and they'll come after really low-level responsible persons, somebody who's in the accounting department and just does payroll and things as part of their job. They're not making any real great high-level decisions for the company, but they know that since this payroll tax, the trust fund, is jointly and severally payable by responsible persons, that they may be able to work a smaller responsible person against a person with deeper pockets that's tagged with the responsible person assessment. So, deadly deal. With the trust fund recovery penalty assessment, I often say it's a gotcha. I mean, you just don't have a whole lot of ways out of it. If you're on the bank signature card, they're more than likely going to assess you with this thing. In most circumstances, it's not a battle worth fighting. There are exceptions to that, and there are ways to challenge that. And I'm not going to go too deep into that, but you do have 60 days from the date that the IRS assesses you, and you'll know that you've been assessed because you'll typically receive a letter, notice of some type, that you have been tagged with this trust fund recovery penalty. You've got 60 days to protest it, okay? At this stage or before they do the assessment, they'll send out these revenue officers, like we talked about, to do what's called a trust fund interview with these folks that they suspect may be responsible persons at the company. They don't have to do this. They can make the assessment, and they do have time periods in which they must assess this. And generally speaking, what that means is the IRS has 3 years from the date of the tax, that the tax itself was assessed, to assess this portion of the payroll tax, the trust fund portion, on responsible persons, okay? And if they miss that deadline, and they do sometimes, then the government's out of luck as far as tagging responsible persons. Now, if a revenue officer is assigned and that assessment date goes by and gets blown, revenue officers more than likely going to be in big trouble with their superiors for missing that. So they don't miss that a whole lot, okay? Revenue officer may come out and conduct this trust fund recovery interview. They do it on a form 4180, and it's assessing all those things that we just talked about. They go through a checklist, essentially, of things to establish really control over whether the person had control over whether or not the payroll tax was getting paid. If you are being contacted in the first instance by a revenue officer on something like this, again, you need to contact a tax professional to try and get in there and figure out whether or not it's worth fighting, first of all. And a lot of times in the same interview, if they've got enough people there that they feel like can answer as to the financial issues of the company, where are the bank accounts is the biggest one, where are the assets and what are they, then they'll also fill out one of those Form 433, in this case B for business, collection information statements, where they're trying to gather up, what are the assets and how much cash does the company have, and what are their accounts receivable. That's another big one, because if everything falls apart in this system of working something out with you on payroll tax and you're unrepresented, then they're just going to use all that information and go levy you. Okay, so got to be real careful with these interviews, with the IRS showing up unannounced when you owe payroll tax. All right. Let's talk a little bit about what relief could be available here. In most cases, we've talked about the types of relief that are available to individuals with IRS problems, and those are things like installment agreements, offers and compromise, different types of penalty abatements or forgiveness, all those types of things. When you owe payroll tax, though, however, you really are talking about either paying it all or getting into some type of an installment agreement with the IRS. Typically, they want to see it get paid out over 3 years. But these things are not just going to be handed to you, even though it sounds like it's a pretty easy deal to get into an installment agreement with the IRS. Again, they're going through all these financials and figuring out what property that the business has. And just like when we talked about with the payment plan for individuals with the IRS, they're going to want the value of any equity in any assets. They're going to want you to liquidate anything that you can to come up with a good chunk of change, or all of it, before they give you an installment agreement. Okay. Now that said, they do tend to, once they've figured out that they have exhausted all possible cash possibilities or equity possibilities for getting paid now or in the immediate future, they will start looking towards the installment agreement, because they want to get you into something, a contract with the IRS to start paying stuff back, because they can then take any proceeds of that money through an installment agreement, anything that you pay them, and start applying that money in the government's best interest. And what that means is they're going to take any money that you pay and start applying it towards the non-trust fund part of the tax, if you want to stay open as a business, because again, they can always come back and go after that trust fund portion, even against individuals. So with an in-business company, they want to get you into an installment agreement so they can start applying that money towards the non-trust fund portion that they can't get against individuals. Okay, so that's an important distinction. If you're not in an installment agreement, and keep in mind this is very difficult to execute if you're a non-professional, non-tax professional, but you need to know, and the IRS hates this, that I'm disclosing something like this, but they cannot designate money if towards that non-trust fund portion if you are voluntarily paying the IRS and designating that money yourself to the trust fund portion. Okay, that didn't come across super clear. So what I'm talking about here is if you're not in an installment agreement and you are being contacted by the IRS, typically through an IRS revenue officer, it behooves you, it's in your best interest, to take any available cash that you might have or that you can get your hands on and write on the check to the IRS that you want it applied to these periods of payroll tax trust fund. Okay, and it makes them mad sometimes that you would do something like that, but they have to honor that and apply it to trust fund if you tell them to apply it to trust fund. Now, don't confuse that with trying to write that in if you're in an installment agreement, because once you are in a contract with the IRS in an installment agreement, they get to apply it towards the best interests of the government. That's always to non-trust fund first, and it's always towards the oldest ones first, because that's the one that the statute of limitations is running the quickest on. Okay, so know those things as you go into this as well. As far as other remedies are concerned, you can always have a ride-along request with your installment agreement for penalty and associated interest abatement or forgiveness. Okay, that's still available. What is rarely to never available for a company, especially one that wants to stay afloat, is an offer in compromise. Okay, there are some offers in compromise. It's a very small subset of offer in compromise that is available to an in-business operating company. Essentially, just know to get one of those things, and it's rare, you must pay all of the trust fund recovery penalty before you can get that type of relief. Okay? Again, lots of these things are outlined in my book at traviswatkinsbook.com. Get your free download of that. And of course, if you are being contacted by any of those people at the IRS that I mentioned earlier, those revenue officers, and you've got a payroll tax problem, give us a call. 800-721-7054. All right. Thanks for watching, and have a great